Depending on where your business operates, you may be subject to some state income taxes, sales taxes, or even franchise taxes. It's like having rules in different leagues or divisions. Each state has its own playbook, and it's crucial to know which one you're playing by. What's up, team? Welcome back to another episode of the Tax Huddle, where I'll be sharing some financial winning plays to help you beat Uncle Sam on the financial field. Now, in today's episode, I'm diving right into how LLCs are taxed. Whether you're a seasoned business owner or beginning your entrepreneurial journey, understanding how limited liability companies are taxed is crucial. So let's huddle up and get ready to tackle the world of taxation to help you make informed decisions for your business. Before we break the huddle, make sure you hit that like button, subscribe to the channel, comment below, and most importantly, pass the video on to your friends, family, and anyone you know who's looking to level up their financial game in 2023. Now, let's break the huddle and dive into how LLCs are taxed. Ready? Break! All right, team, so let me break it down for you. What exactly is an LLC, or a limited liability company, and why is it typically the most popular choice for most business owners? An LLC is like your playbook. It's a versatile business structure that combines the best of both worlds when it comes to partnerships and corporations. It's like your safety net that keeps your personal stuff safe when things get tough. This protection is like a solid offensive line. It guards your personal assets like your home, savings, and a lot more from getting mixed up with your business problems. So you can focus on playing hard within your business field, knowing that your off-field life is secure. Now, to form an LLC, this is like sketching out your strategy. You start by submitting what's called the Articles of Organization to the state that you reside in. After paying that filing fee, now you're ready to step onto the field with the legal framework to run a business like a professional. Now let's discuss taxation. With the LLC, you have a distinct advantage. Your business's income and losses are reported on your personal tax return. This keeps things uncomplicated. Unlike larger corporations that deal with double taxation at both the corporate and the individual level, you don't have to deal with that. This is what's called a pass-through taxation method, which is like avoiding unnecessary complexity. It's a straightforward approach that saves you from the tax burden faced by those bigger corporations. In addition to that, you have the flexibility to choose your business style. Whether you prefer to have complete control like a single member LLC, or you want to have some teamwork with a multi-member LLC, the choice is completely up to you. It's about aligning your business strategy with your preferences. So, in summary, an LLC is a versatile asset. It provides personal asset protection, eases the tax process, and allows you to operate your business as you see fit. But hold on, we're not finished yet. Having covered the fundamentals of what an LLC is, let's explore the next stage where we're going to dive into the different taxation options for LLCs. Each one comes with its own set of rules, so stay with me as we dive a little bit deeper into the world of LLC taxation. All right, team, so let me give you a quick overview of how LLCs are taxed. Just like a well-coached team has versatile plays, LLCs offer different taxation methods tailored to your business structure and goals. So first things first, LLCs can be taxed in various ways based on how they're set up and the choices made by their owners. And it's essential to understand these options so you can create the best strategy that suits your game plan. For single member LLCs, they're considered a disregarded entity for tax purposes. This means your business income and expenses are reported on your personal tax return using a Schedule C. In a nutshell, it's like merging your business finances with your personal finances. This simplifies your tax reporting and keeps things very streamlined. Now, for multi-member LLCs, they're typically treated as partnerships by default. Profits and losses are distributed among the members based on the ownership percentages. To report these figures, multi-member LLCs file the IRS Form 1065, and each member receives a Schedule K-1 that summarizes their share of the business's financial action. In simple terms, this ensures that everyone on the team contributes and benefits according to their ownership. The key here is to consult with a tax professional who can guide you through choosing the best play for your unique situation. Your decision can significantly impact your financial success of your business long term. So, whether you're a solo player or part of a team, or just looking to change up your game, there's a tax strategy that suits your business style. Consult with a tax expert and make the right call for your business. Now that we've covered the basics of LLC taxation, let's get into the taxation specifics for single-member LLCs and multi-member LLCs. First, let's dive into how single-member LLCs are taxed. Single-member LLCs are automatically treated as a disregarded entity for tax purposes. This essentially means that for tax matters, your business and you as the owner are considered one and the same. It's like if you were the star quarterback on your team, you're carrying the weight and the responsibility of the entire offense. So all the income your business earns, as well as all the expenses it incurs, are all reported on your personal tax return. To be specific, it's done using an IRS form Schedule C. Your Schedule C is where you list your business's income and expenses. It's where all the financial action happens. This is where you detail your revenue, any costs, any deduction to determine your business's profit or loss. This information then flows onto your personal tax return, which shapes your overall financial picture. Essentially, it's a way to simplify your tax reporting to make sure that your business's finances are seamlessly integrated with your personal finances. So, in a nutshell, as the owner of a single-member LLC, you're responsible for the business's income and expenses, and you have to report that all in your personal tax return using a Schedule C. So, now that we've broken down the taxation details of a single-member LLC, let's switch gears a little bit and explore the multi-member LLC taxation. Multi-member LLCs operate a little bit differently. They're typically taxed as partnerships by default. In this case, the profits and losses for the businesses are allocated to members based on their ownership percentage. So, if you own a larger piece of the pie, you're going to get a larger portion of the profits. But you also share a bigger amount of the losses. So, every member plays a role, and the gains and the setbacks are all distributed accordingly. To report these figures, multi-member LLCs need to file an IRS Form 1065, also known as the U.S. Return of Partnerships Income. This form outlines the overall financial performance of your team. But the story doesn't end there. You also need to provide each member with a Schedule K1. This Schedule K1 is a personalized playbook for each member, which summarizes their share of the business's financial actions. It'll outline the distributor's share of the income, deductions, and credits. Each member then uses that Schedule K1 to report their share of the business's financial actions on their individual tax return. This process ensures that everyone on the team contributes and benefits in proportion to their specific ownership. So in summary, multi-member LLCs are where profits and losses are distributed according to each member's ownership percentage. You file an IRS Form 1065, and each member gets a Schedule K1 to report their share of the financial actions. It's teamwork at its finest, both on and off the field. Now, let's shift gears again and discuss how multi-member LLCs can elect to be taxed as an S corporation or C corporation, which adds a whole nother level of complexity and opportunity. S corporation and C corporation taxation are like two different strategies for your LLC. Just like having different strategies for different parts of the game, choosing between these two tax structures requires careful consideration. First, let's discuss the process of electing to be taxed as an S corporation. To make this change, your LLC must file Form 2553 with the IRS. Once approved, your business gains the benefits and the drawbacks associated with S corporations. S corporations are known for the potential tax benefits, such as avoiding double taxation. The profits pass through to the shareholders, just like a partnership or sole proprietorship, which can then result into some more tax savings. However, it is important to note that S corporations do have some specific limitations. They may have restrictions to the number of shareholders, and all shareholders must be U.S. citizens or residents. On the other hand, electing C corporation status is a different play. This involves filing the IRS Form 8832 to change your LLC's tax structure. Once you're a C corporation, your business now stands alone for tax purposes, separate from its owners. C corporations have their own set of potential benefits, such as limited liability for shareholders and the ability to raise capital by selling stock. They can also have more flexibility in structuring their employee compensation and benefits. But just like in football or in any other game, there are some trade-offs. C corporations can face double taxation. The business pays taxes on its profits, and shareholders pay taxes on dividends they receive. This can lead to a higher overall tax burden. Also, C corporations often have more complex compliances and reporting requirements. So, when it comes to electing between S corporation and the C corporation taxation, it's just to weigh the potential benefits and drawbacks. That choice will have a significant impact on your business's financial strategy. So now that we've covered the essentials of S corporation and C corporation taxation, it's time to shift our focus to some key tax considerations that every LLC owner should be aware of. As an LLC business owner, there are key tax considerations you always have to have on your radar. First and foremost, we have to know about self-employment taxes. If you're actively involved in running your own LLC, you may be subject to some self-employment taxes. These taxes cover both Social Security and Medicare contributions. And then we have state taxes. Depending on where your business operates, you may be subject to some state income taxes, sales taxes, or even franchise taxes. It's like having rules in different leagues or divisions. Each state has its own playbook, and it's crucial to know which one you're playing by. As an LLC business owner, we also have to remember to consider estimated tax payments. Making regular estimated tax payments can help you avoid penalties and surprises come tax time. This is especially important if your LLC is generating a significant amount of income. And I'm going to say it again. Don't forget to keep detailed records of your business transactions. Accurate bookkeeping is like reviewing game tape. It helps you monitor your financial performance, claim deductions, and handle any audit with confidence. Now, tax rules can get a little tricky, which is why I highly recommend that you consult with a tax professional or financial advisor who specializes in business taxation. Their knowledge can assist you in maneuvering through the always changing tax code. Lastly, always stay updated with the tax law changes. Tax regulations evolve. Just like the rules of a game can change from season to season, staying informed ensures that you're playing by the most up-to-date playbook. So to put this all in a bundle, these tax considerations are like a playbook for your financial strategy as an LLC business owner. Be aware of self-employment taxes, state taxes, estimated tax payments, and make sure you consult with a professional and stay informed. With this knowledge, you're better equipped to make strategic moves and level up your financial game in 2023. And there you have it, the playbook for understanding how LLCs are taxed. If you enjoyed these tips and want to see more financial winning plays, please take a moment to hit that like button, subscribe to the Tax Huddle, and pass this video on to your friends, family, and fellow financial players. Until our next huddle, I'm your coach, Ibrahim Muhammad. Take care.